Have we learned anything? Are we any smarter 10 years down the road than the quants were 10 years ago?
We're a lot smarter today than we were 10 years ago. We're really now, I would kind of say, almost in quant 3.0, where 10 years ago we were really in the end of quant 1.0.
Fair.
We've learned a lot more about how to get out of each other's way. We've learned a lot about trading. We've learned really what other people know, and really the world has become so much more digitalized every day. And so just the levels of data that we have, the machines at our fingertips are just so much more powerful that we've just made a lot of advances.
Whether it's 1987 or 1998 or 2007, it's about blown up certitude of hedges or arbitrage, where I've got a constructed trade that blows up, maybe it's leverage or whatever. What is the constructive trade of 2017 that worries you?
What worries me is, one, there's just been a rush into quant, and there's almost been a little bit of a mania on the belief that of what machine learnings can do for you and what it's capable of. I think we need to take a step back and really think about where we are and what it can do and can't do.
Full editorial, I 100% agree with that statement, and you see the FT article today, which really shows the wall of money going into your world. Nassim Taleb is anti-fragile, talks about stressing and testing the system, about robustness found through small failures. Are we there yet? Are we more anti-fragile, where you've got a greater confidence in the system?
I think that what we've really learned was what I learned the first day in my class at the University of Chicago, where Eugene Fama kind of came in and said, everything I'm going to teach you is wrong. It's a model. Right? And we know it's a model, it's not reality. And I think that most quants are very careful now to understand where their models fail. What worries me is that that becomes a lot harder when you get into the deep learning machines and artificial intelligence to really understand what your machines don't know if you don't really know what your machines are doing and how they're doing it. And I think those are the kind of systematic failures that worry me.
Matthew, where do you think the next financial crisis will come from?
What worries me most about that is that we've been in an era of very low volatility and in an era of particularly low dispersion across returns, which is different than volatility. General volatility can be driven by macro events, and so you can see the VIX spike on macro news, but all stocks may or may not move together at that point. What's really remarkable about this time is that we've seen very low dispersion across returns. Idiosyncratic news, as we kind of call it, or individual stock-specific news, those features are very low, and so that more than the VIX being low is what I think leads people towards leverage. And so what we really need to see is for some kind of orderly pickup in dispersion across returns.
Right, but Matthew, what I'm trying to get at, right, is that you're saying that quants are more careful now, so that they learned things in terms of models, that they look and the analysis that they're going through because of the financial crisis. But what if we had a financial crisis or a crisis that came from something that we hadn't even thought about? What does that mean for your models, the quants models?
It means something bad for everybody's models. You know, if there's something that none of us can foresee, of course your quant models aren't going to look at it, and of course your fundamental analysts aren't going to get it. It's bad for everybody.